Hey, everybody. Before we kick this episode off, I just wanted to, 9/11 just recently passed. I just wanted to acknowledge all the veterans, all the people that are actively serving, and all the families that were affected in 9/11. These two rebels here are definitely thinking about you, and we just wanted to acknowledge you.
But who has all of these assets? The wealthy
Right.
people. And as these asset prices increases, like they're going to benefit the most. And if you don't have these assets, the wealth gap is going to just get bigger and bigger and bigger.
They have, there's tripwires in place to trigger the cut of these rates, right? So for those reasons, I feel like whether they would have cut it before or cut it now is good. Waiting is not the right answer. I think at the latest, this was a decent.
Yo, B, let's go.
You may have seen the clip and maybe heard word of mouth, yet another podcast. Man, what could it be about? Is it truth or opinion? A couple of contradictions. We're here to challenge tradition and twist your vision. So we set on a mission to bring you rebel wisdom.
What's going on, everybody? We're back with another episode of Rebel Wisdom. Typically we like to kind of throw some random topics at you guys, but this week we're going to do something that's somewhat relevant, and it's going to be the Federal Reserve topic on the interest rates and what's kind of going on in, I guess, recent events and how it possibly could affect us or the overall economy at large. So that's what we're going to dive into today. And typically when you hear the Feds cutting interest rates, I think the general narrative behind that is a positive outlook. Like most people hear that and think like good things are coming to our economy, like our economy is getting stimulated and it's going to be for the benefit of the whole, which, personally, I tend to agree with. But how good is that benefit is what we're going to kind of dive into and kind of dissect on what that could really mean for us. But you got anything to add before we get into it?
No, I'm excited to talk about the money stuff and the current events.
Yeah. This is current events not being a norm for us, but it's good to dabble in it every now and then.
Yeah.
And, we like to get some money topics in here when we can. So like we said, go ahead.
We're recording this on August 27th, and this should be going live on September.
When you say going live, you're talking about the interest rate cut taking effect, right?
No. This podcast is gonna air on September 16th.
The cut takes place September.
It releases. This episode should go up September 16th, and the meeting happens on September 17th and 18th to actually cut the rate.
Yeah,
so it should be very valid by the time this gets posted.
Okay, that's a good turnover. Okay, that's good. All right, sweet. So, like we were saying, generally speaking, interest rates getting cut, that could have a couple of positive ramifications, right? So I guess we can just kick it off, kind of saying what that means for us, and maybe dive into some of what those positive ramifications would be. We can start by dissecting how this interest rate cut can be beneficial to us, and we'll start by saying like what some of the pros are to the cut. So, as an everyday consumer, as someone that, has some varying assets, what are some of the most things you're excited for this interest rate cut? Are you looking forward to?
Yeah, so with interest rate being cut, that, like you already said, it's going to stimulate the economy, and with stimulating to the economy, it's going to create more jobs for everyone, and it's going to bring up asset prices. And I think a lot of people, I don't want to say majority, I don't know the exact numbers, but a lot of people have money in the 401ks, right? And then so 401k account, if it's exposed to the stock market, which majority of the people should be exposed to the stock market and their 401k fund, it will be going up pretty much. That's the easiest way to put it.
Mm-hmm.
Not accounting for outside external factors, right?
Mm-hmm.
With comparing A and B, where A is higher interest rates and lower interest rates, your stocks is more likely to go up on a lower interest rate because there's a lot of money circulation happening with lower interest rates.
Okay.
And with that, it's not just stocks, right? It should be bringing up a lot of stuff, except for the bonds, right? Bonds, their yield is going to decrease because federal rate is going to go down. And I'm personally excited for the lower interest rates to come back for real estate.
Oh
So
yeah, that's what I was
a
waiting
lot of
for.
people that's invested in real estate, like I mean, you see the articles from here and there where all these multifamily operators are, you know, getting foreclosed on their property because they couldn't refinance.
Right.
And at least for me personally, I bought an investment property back in January, and I have a 8% interest rate because
Mm.
interest rates for investment loans are typically a little bit higher than a primary
Right.
occupant's loan. So, I mean, I'm definitely feeling the pinch on that one
Yeah.
for that particular property. So I'm just excited. This what we're hearing right now is that they're going to cut starting September. That particular cut is not going to change anything for us, but it just defines the beginning of the rate cut cycle, which eventually the Fed says and by the end of 2026, they want to get to 3% Fed fund rates. So right now it's sitting at 5.5, so it's overall a 2.5% decrease.
Mm-hmm.
And then we'll see where it goes from there. They could not fulfill that projection, or they could even
Right.
go lower.
Right.
And then if that's the case, a lot of people are going to be refinancing. A lot of people are going to be ready to buy a home at that point because interest rates so much lower. But because of that, it's going to increase housing prices. So if you already own a home, you should be very excited.
Yes.
It should be very excited for that. And yeah, like I said, the change is not going to take over. The change is not going to take place overnight. It's going to be over a few years. But money-wise,
Yeah.
positive things should be coming our way.
Which I feel like it always is. And you mentioned a couple things I want to tie in. You said the beginning of a cycle. And it was funny because while you were speaking, I was thinking to bring up the cyclical effect, right? Like this will never be a permanent implementation. This is something the Fed can implement to kind of steer, maybe stimulate, as we usually hear, the economy. So this is the mark of the interest rates going down. But as we all know, at some point, right, it's going to come back up because this is a cyclical effect. And then you brought up you specify the audience that this might help a little bit more than others. Basically, just stating that, if you already own some of these stocks and if you are fortunate enough to be a homeowner, things like this benefits you specifically because the price of stocks will go up, which is bad if you're looking to maybe get into the stock market. But again, if you're a stock owner or you hold shares, hey, this is good news. Likewise for homeowners. So I think that's an interesting point to make, and just want to tie that into some other things we spoke on before about, we all come from different socioeconomic backgrounds or have we stand in different financial situations. But again, if the earlier you can get into these things, as a general rule, earlier being, younger in your life, this is good because you can take advantage of more of these cyclical effects, I would say. And then just ride out the benefits in the long run over time. So again, for those that do have these certain assets that will specifically benefit, definitely we're looking at good times here. But to enter some of these areas, it might not be the best time, which is why this is good. But the net I'll say the net good may not be as big as all the hype is because for multiple reasons that we'll get into. But I did just want to highlight the cyclical nature of this, because what goes up will always come down, and vice versa. So I thought that was a good point.
That's dude. Regardless of what I think you brought up a very good point. If you're young, I mean, even if you're not young,
Yeah.
regardless of what the interest rates do, the best time to buy an asset was 10 years ago.
Right.
Second best time is today.
It's now.
So if you're in that position to regularly invest in the stock market, or if you're financially ready to buy a home, you should make that. You should not be trying to time the market, because I don't know, it's crazy because there's so many people that say, if you go to a family dinner and you say, for example, I'm gonna buy a house, they're gonna say, oh, it's a terrible time to buy, blah 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 blah. You hear that every single year, regardless of anything. And one thing I'm gonna disagree with you on is at the end you said what goes up must come down.
Yeah.
But that is not necessarily the case for a lot of assets.
Okay.
It does move in cycles. It does, it goes rubber band up, brings it
Yeah.
down, rubber bands down, and this, somewhere along the way, hits that,
Yes.
median point. But I do want to caveat that, because a lot of people online I hear it's like the housing market has to come down because it's
Mhm.
overinflated. It doesn't work like that. It's, as inflation takes place, asset prices are going to naturally come down, and that's the
Yes.
fair market value of the asset given inflation. So it's, a lot of people try to time like, oh, I'm not going to buy a house now because XYZ reason. Dude, if you're ready to buy a home
Yeah. Yeah. Yeah.
financially, you should buy a home if you want to, right? Not everyone wants to buy a home. So
Yes.
that's the only, I do want to say that. And objectively speaking, I think this is like a great time to buy a home, to be honest, because I'm in the camp of there's not going to be a housing crash. Like people generally refer to the 2008 level. I don't
Yeah.
think that's going to happen anytime soon. Looking
Okay.
at the stats,
Yeah.
like June of 2024, we just hit an all-time record for national home prices.
Right.
Right, and people are going to say, "Oh,
Which
my
is what not,
market."
yeah, a lot of people
Yeah,
weren't like expected. Yeah, which
yeah.
went counter to what some people thought was going to happen.
And a lot of people were like, "Dude, what in my market?" Well, I don't care. I'm not talking about your market, right? Like if your market goes down 5%, then somewhere else it went up 15%. You know, but nationally, the house prices
Nationally.
are going up, and it just hit an all-time high. So I wouldn't call that a housing market crash.
No. Yeah.
And people are like, "Well, it's a bubble. It's gonna come down." I don't
The good old
think it
bubble.
is, because usually when interest rates go up, housing prices go down because there's less demand. But it did go up a little bit, which
Mhm.
kind of accounts for the fact that housing remains a strong asset. People want that asset, and that should be a caveat, like, or that should be like a crazy data point, because if interest rates went up and housing
And
prices went up, imagine what's going to do when interest rates go down.
yeah.
It's going to go up even more,
Right.
right? And I think this is a great time to buy it, like I said, because purchase price is something that you cannot change once you buy a home.
Mm-hmm.
But payments, primarily the interest rate, is something that you can change as prices go down.
That's a
And
great point.
because they announced that interest rates going to be going down in the future, you can lock in the price that's at current interest rates, right?
Okay.
That's pretty high, and it's not a guaranteed, but it is a educated, strong guess that interest will go down, as the Fed says, and just refinance later.
Right. Can refinance.
That's the best way to. I mean, there's gonna be so many people that disagree with,
Yeah.
but that's basic, like, economics 101.
Right. Which is so
Right.
funny because for like it's like how do I say it? It's contradictory because do I think there are strategically better times you can buy a home? Yes. But what you said also, it's like I guess maybe it trumps if you're ready to buy a home because it's going to be cyclical. Do I also think you should probably just buy? Yes. So it's like I think you're better off buying when you are ready by like you said, trying to time the market. But I mean, of course, there's going to be times where it's like a little better to buy here, and then there's local markets versus again like nationally. So it's all there's caveats with it all, I guess. Yeah. All right. So talking about what's up?
No, this is like I kind of went on a tangent, but that was all the
Uh,
positives, I guess.
I know I mean it's good stuff though because again I feel like this is stuff that's not often talked about, and then we can highlight the positives of the interest rate going down, and then again some of the negatives that come with it. So talk about like the interest rates of housing, but like me and you were talking before, maybe like the interest rates, like I have a high yield savings account, like the interest rates there, if they go down, like that may not be a good thing if you're like benefiting from those interest rates. So
hmm
it could go either way depending on asset. All right. What's let's talk about some of the I guess the risk for inflation.
hmm
Rates fueling the inflation by increasing the customer spending, which I think kind of goes into stimulating the economy a little bit.
Yeah. So I mean, as So Fed fund rate going down will make borrowing easier,
Right.
or just you can borrow not easier but cheaper, I
Yeah.
guess. And then
It's the same.
when you borrow money, and that as that gets injected into the economy, everyone make it. It seems
It's a
like
net
everyone
gain.
will have more money,
Yes.
and people are going to be spending, and that therefore makes the economy stronger. But the biggest risk I see with interest rates not decreasing is because they're going to be spending. People already spent so much money already, even on higher interest rates environment. It's crazy. Like just coming out of COVID, everyone's like spend, 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 spend.
Yeah.
And
Consumerism, I guess, is at a high for sure.
yeah, like we talked about the consumer credit card
Yeah, we
being
did.
at all time
Yep.
high
Yep.
during the credit card episode. And imagine when easy money comes back again, right? And when that happens, because there's going to be so much demand to buy goods and services, and if that supply does not keep up with the goods and services being
Hmm.
demanded for, then it's going to naturally cause another, I don't want to say a cycle, but another wave of inflation going up. And I think that's the biggest risk with Fed funds rate going
Mm.
down, because
What is
I
the
mean, like,
consumer spending? Are you saying is the biggest
no,
risk?
just inflation.
Oh, inflation. Okay. Okay.
Yeah, because like they're trying, like they got inflation down to a manageable level at this
Right.
point. At least that's what the data says,
Yeah.
regardless if that is true or not. Um, but I mean, it's if inflation keeps going up, again, it's gonna be one of those things that rents increased so much from 2019 to 2023.
Hmm.
Grocery prices went through the
Oh
freaking
yeah.
roof, and then as things get inflated, on top of the economy getting stimulated, that's gonna fuel assets to go up again with housing, stocks,
Right.
I'm
Right.
guessing crypto. So if you missed a boat, like try to hop in as early as you can, or you're gonna just get left behind. And that's just creating greater socioeconomic disparities between the wealthy and the poor and the middle
Oh
class.
yeah.
So if you're not fortunate enough to, not even like, you may not have a choice, right? You could be just graduating college
Hmm.
like this year, and you never had the chance to participate in the economy at a, maybe they had a part-time job or whatever
Hmm.
up to now, and then because they couldn't buy a house in, 2018, it's gonna just get harder and harder to buy a home.
Yeah, for sure. So something else you said was the income inequality and how the wealth gap might get like exacerbated essentially, which I think is also just an interesting side effect that I think is worth being noted, um, because it's almost like a facade. Well, it's not a facade. It is good, like to take it back a little bit, saying that the interest rates going down kind of fosters the spending, but could lead to such inflation that the prices continue to go up. So it's like on an individual level now, like you said, groceries are through the roof and whatnot, and you can feel that on the individual level. Although it's like, hey, the economy's being stimulated, and this is where I think we get that like I said, facade. Like, hey, it's good, but what we're rebelling against, is it as good as we think? And then to the wealth gap being exaggerated. Again, like we said, for these people, that are owning these assets and can take advantage of this, maybe certain credit, um, they're benefiting. But for the people on the other end of the aspect, on the other side of the wealth gap, it's just getting harder for you to get in, which is kind of like you're saying, like, don't miss the boat. Definitely needs to be thought about, or I think is a very valid point of this conversation. So thank you for tying those two in, because I certainly something I think we're going to see that like is not thought about. Like, I don't even really think about all like that either.
It's just like it's gonna be a gradual change that takes over years,
Mm-hmm.
but then it's gonna be one of those things that, like, people that say, "Oh, stock prices are so high," like the S&P 500
Mm-hmm.
crossed over 5,000. That's
Yeah, that was
so
that all time. Yeah.
inflated. That's so inflated. It's gonna come down, and those are gonna be the same people in 2026, 2027. That's like, I wish I bought stock in 2024. I wish
Yeah.
I bought a house in 2024. That was such a great time to buy before. So you,
Yeah.
I mean, with those people, you can never win their argument because they're always gonna say something. And it's usually because they don't have, like people that have stocks, they're not gonna be like, "Oh, stocks is so overinflated," because otherwise they would be
Right.
selling, right? If you truly
Right.
believe
Right.
that.
If you right. Yeah, get out if you think it's
Yeah.
gonna crash. Yep. Yep.
And then, I mean, counter to the people that don't have these assets, they're gonna just be paying for the the I guess just the end effect or the causes, all not the causes, the after effect, aftermath
Mm-hmm.
of these assets going up, where it affects everyday people is I just want to bring it back to real estate because everyone has to have a place to live,
Yeah. Talk about rent.
and yeah, it's gonna be up. Yeah, as house prices goes up, rent's gonna go up.
Mm-hmm.
As building materials goes up, and as permitting
Mm.
process
It's going
keeps
to.
going up, and labor people, technicians and trade workers, they're going to demand more for their work.
Yeah.
That's going to naturally drive up the prices of apartment buildings and single family homes, and the people that buy it, they want to return on their money, right?
Right.
So they're going to have to not have to, but they're going to start raising rents naturally, and the people that move into an area that don't have too much housing in the first place, they're going to be stuck paying that money.
Yes.
I don't
Yeah.
know. It's not going to be good.
Right. It's not. And then counter to, some of these things with like prices, if I'm seeing somebody and I'm watching this economy shift and it's like, okay, these prices are going up, and maybe you shift from a consumer mindset to a savings mindset, right? Because of this inflation we're seeing, or let's say you are renting in this market, you see this and you see rent going up. There there are some disadvantages from a saving perspective too, like we kind of touched on. But if the interest on your savings account isn't doing as well, so now your money in your savings account, isn't accruing as much money, or there's diminishing returns on like low risk investments. So even from a consumer's perspective, it might be getting hard, but even from a savings perspective, things could not be as bright and fluffy maybe as we think either, for some of these same effects that we see for savings vehicles. So I just think it's interesting to like compare the two. No matter what mindset you in, if you're consumer versus savings, you feel it either way.
Yeah.
Yeah.
And I think, majority of people that's good with money will agree that you should have an emergency fund.
Oh yeah.
And then,
Right.
it's definitely nice seeing a few $100
Right.
deposit into your high yield savings account, because the rates are like 4.5%.
Yep.
Right. And
Absolutely.
then, you saw like during COVID, I think I was getting like 0.01% from my savings account. And then even on the high yield savings, like the best I saw was like 0.8 or something like that.
Okay.
Maybe I
Okay.
could be totally off. Like,
Yeah.
but it was not high. That's the point.
Right.
And yeah, there's a lot of investment vehicles that people value that's, returning good
Mm-hmm.
percentages today, like especially with it being risk free, as or close to risk free as possible, like buying bonds,
Yeah.
CDs, high yield savings accounts. Like those are the most like risk free assets that you can possibly buy.
Okay.
And then like CDs, you can get a CD easily for like 5% right now.
Right.
So, and that's not going to be there, and then naturally people are going to have to go into those, I guess you could say, riskier assets. I don't agree with the definition, but they're going to flock to stocks and stuff, which is going to keep putting that demand up. And yeah, they're just such a strong message, or at least I feel that Fed cutting this rate is just an overall glamorous, like, glory days are coming. But I don't hear people talking about the downside of rates coming down.
Right.
Did we not see, did we forget about the COVID times? That was a one-off,
that was kind of,
that was a unique situation.
Yeah.
But you saw the economic effects of it. They cut rates straight to zero. And then, I mean, you saw the prices, how it turned out, right?
Yeah. Do you think as a result of this, as the interest rates coming out as a long-term effect, people could um it could cause instability that could actually put people in debt like more than expected? Because I think when you again like we're saying the rates get cut, so there might be, with the market being stimulated, there might be an uptake in consumer or just not being able to save as much. Do you think what it's kind of hard to say long term because like we said the market's cyclical, but do you think,
I
I don't know.
I could see it because the point that you brought up, how like with inflation, right? I'm gonna make like a exaggerated example,
Yeah,
but
okay,
if you
go
have
for it.
$100 in your savings account today,
Mm-hmm.
then I told you because of inflation, your $100 tomorrow is only gonna be worth $50.
Yep.
Like, what would you
Very
go do
drastic.
today?
Yeah.
Like, you're gonna go spend that money, right?
Right, because I
Well,
don't
it's
want it to,
worth
while
hundred
it's worth,
dollars. Yeah, right.
maximize the value. Yeah.
So obviously, it's not as that drastic, but as inflation goes on, like it's gonna be with savings, APRs going down and
Mm-hmm.
whatnot. Your people are gonna be intense or encouraged to spend their money,
Okay.
and if they don't control the spending of the money, people with bad spending habits and bad financial planning and execution,
Yeah.
they can easily slip into consumer debt, and I could see that playing out very realistically.
Right, right. That's why I feel like it again, it's good, but I mean, kind of like you said, it falls back on financial habits, with which is we could insert that in any conversation really, but I feel like I don't want people to just be able to be like sit back and breathe easy just because like interest rates are coming down. Like, no, there's still things to be cognizant of, I guess, is what the overall point I'm trying to make in this, in this part.
I think it's gonna be like a recent phenomenon that we see in the 20th century that we didn't see before. Like, you hear the sayings like, "Don't keep up with the Joneses" or something,
Mm-hmm. Yeah.
right? Like back in the day, you only could compare yourself to like your neighbors,
Mm.
right? And then you even inside of neighbors, like you didn't really see their day to day lifestyle because you didn't have
Right,
social
right.
media and whatnot.
Okay.
But now, as money floats into the economy, and you see all these TikTokers and social media
Mm.
people, they only show you the positive side of them spending money, blah blah blah, all that
Yes.
stuff. And
Oh man.
people are gonna feel that social pressure to spend even more. Not that it
Okay.
doesn't already happen today; it absolutely does, but it's gonna be just at a grander scale, I think. And that's gonna just, dude, you gotta stay strong. You gotta stay strong, not to fall for these things.
Yeah, you do. There's definitely that's societal pressure for sure. Yeah, that's it. I'm just trying to think now. With again, technology is another thing you can weave into most of the conversations we have, but the just ease of technology, or to see how other people are reacting, or fall victim to that influence, or even, I mean, the ease to manipulate your own money. Whereas I don't know how many years ago that you might have to go to the bank, you might have to like talk to somebody and do it, but now you can just hop on your phone and boop, boop. You can spend, you can shift accounts, you can transfer. Um, so I feel like the effects of this low interest rate, like it felt on the individual level, again, it's so fickle because we can manipulate our money again in this digitalized age so easy and so quickly that you could argue that we feel these shifts just that much more. I mean, it's probably not a huge, probably doesn't make a huge difference. But again, the fact that we can manipulate it so easily, and then we as humans can be manipulated so easily, is just, I don't know. I really never thought about it like that. But you can just feel that effect that much quicker.
Yeah.
Which would be something interesting to dive into and see if that, like, if an interest rate cut, I don't know, 30 years ago, the timing of how it affected the market versus now, the equivalent, the same equivalent interest rate cut, do you see markets shift quicker just due to some of these technological advancements? That'd be interesting to compare. Like, I'm sure the stimulation of the market would hit slower, years past than now.
Oh, interesting.
which
I
overall might
actually
affect the cyclical nature. You know what I mean? Like I don't know.
I read an article or some kind of study on this, like when I was like really into the stock market.
Mhm.
But they were talking about how the stock market cycle, like stock market, you're gonna have some booms and busts, right? It's just the
Yeah, of course.
nature of
Yeah,
the
inevitable.
investments. And they were talking about how in the past the boom bust cycle was much longer, whereas as time and
Mm-hmm.
I'm guessing like information travels faster and more people are aware of the stock market and whatnot, like the boom bust cycle is much quicker. So I could,
That make
I
yeah.
yeah,
You know what I mean? That's probably a product of the ease of information and ability to manipulate money, and it just almost like distorts the economy in these
yeah,
ways.
the, yeah,
This might be irrelevant, but it's like the whole GameStop thing when one guy can come online and manipulate the masses, and there's this big rally behind a somewhat random, like that stock just gets way overvalued, and it's like you couldn't have created that. I don't think like 30 years ago. You know what I mean? That's like a micro example, but
yeah. No, I mean that's a great example because like I could see it where we talked about how inflation's gonna naturally push stock prices up,
mm-hmm.
right? And they're gonna like people are gonna see this. Obviously, stocks gonna be going up like 30% in a year or
Yep,
something like that,
yep,
which is
something
not
crazy.
uncommon.
Yeah,
And you see all these people making money online, which people will be they're gonna even if they're invested in a stock market, they're gonna see that 30% growth on their account, and they're gonna think they're a genius.
no,
Like, yo, I'm guilty of
oh,
it, right?
I mean,
When I
it
first
feels
made money,
good. It feels good.
I was like, dude, like I might be the next like Warren Buffett, I could be. Maybe
You
I'm the
could
chosen
be.
one.
Hey, you still might be.
But in reality, just riding that bull wave of the stock market.
Right.
But that opens a very dangerous door because that like if you know that you're gonna make money, why not be leveraged, right? With
Mm-hmm.
options or margin loans
Mm.
for the stock market. And I mean, look what happened, right? I mean, GameStop goes up like
Yep.
crazy. They're, oh, dude, it's gonna go up. Let me buy more options and let me take out loans to invest. Let me cash
Yeah.
out my 401ks to
Oh,
invest. And it comes crashing down, and people are in a worse like
fine.
state
Yep.
than and majority of these things, by the time that every retail investor is getting into it because of these hype,
Mm-hmm.
it usually signals like an end of a rally, right? You know what I'm talking about?
Okay. Okay. You said when people are getting excited, say it again.
When people, the retail traders, the
Oh,
everyday traders,
okay.
get
Okay. Okay.
excited and
Yeah.
they have a determination that they're gonna leverage and get into it, it's
Yeah.
usually the party's over.
Yeah.
The smart money gets invested in it first, and then other
Yep.
like firms come in, and
No,
by
that's a
the
good point.
time the everyday Joe comes, it's
It's
usually
already
at the
on its
top.
way to yeah.
So
About to
they get hurt the most because even
right.
if they didn't partake in this, I would say a gamble for argument's sake. Like they would have been a better place if they just didn't participate in this
At
gamble.
all. Which is why you hear sometimes like surrounding stocks, like, oh, be careful when you start hearing like the buzz surrounding the stock because
Yeah.
now everybody else caught on. But it literally, to your point, I've heard this phrase like multiple different ways, but everybody's like, oh, be wary when everybody starts talking about it because you think it's like, oh, I'm catching it on its way up, but it's like it might be at the peak. You might get in, and then literally right after it goes down.
I think it was Warren Buffett that said it. I could be wrong.
Oh, I'm sure
But
he
he
did.
said when your cab driver starts talking about stocks, get out.
Yeah, it's like when
Something like
that's
that.
when it, yeah.
Yeah.
I mean, I wouldn't doubt it. Um, no, for
But
sure.
during a recession, you feel the pinch. Like and when your stocks is going up month to month, day to day, week to week,
Mm-hmm.
like you just want to keep talking about it, right?
Exactly.
And as it starts going down, you're just like, I just hold it. Maybe I cash it out. You're not interested in it anymore. You're
That's
not
not
making
it.
money.
And that's a good way to put it. Now that when like hearing you say it like that, and it kind of going back to these interest rates, it's like you can't. I don't know. It's like it almost has to be an emotionless venture.
Mm-hmm.
Like you don't want to with interest rates going down or with stock prices going up or going like you know, oftentimes you don't want to follow that knee jerk reaction because of how whatever market is likely to relate. You know, like you said, oh, stock price dropped a little bit. Like, oh, let me sell everything. That goes counter to most of the
which is when stocks go down, people should want to buy more.
yes.
I say this very easily into the mic. I definitely, it was hard for me to do. But one thing that we can be not certain of, but almost confident is asset prices will go up in the long term.
Mm-hmm.
So like when you look 30 years from now on, it doesn't matter if you bought in 2022 or 2019 or 2026. It doesn't matter. You're gonna make a boatload of money, and 50 grand here and there, you're still gonna be happy because you made 500K.
Yeah.
You know, so
I think that phrase you just said closes the loop on two things. Like asset prices will go up on the long term. When I said earlier, like prices go up and come down, or like what goes up must come down. Yes, but it's not always equal, which is like what you were saying. In the aggregate, like the trend over time will be trending up. And then that also speaks to us just saying, you know, when you said the best time to get in is 10 years ago, second best time is now, because even if it's the worst time to get into enter whatever market, you know, housing, stock, whatever, even if it's not the best time now, it's going, again, more than likely, especially if you wait long enough, definitely, it's going to trend up. So it's just about, you know, kind of pulling the trigger and getting, you know, if you're at a comfortable position where you feel comfortable to get in, instead of trying to analyze every little point of inflation, interest rate, stock market fluctuation, you name it. Sometimes you just got to get in and ride the wave. Ride the wave.
Yeah, $500 that you put in during a downturn, like it's not gonna make a difference, dude.
Right? Yeah.
Like if you're investing $500 every single week for 10 years, that's gonna make a difference.
Well said. That consistency.
But going back to, we just kind of went to personal finance a little bit, which is fine. But bringing it back to the Fed fund rate.
Yeah.
So we're recording this Tuesday on August 27th. But this article this topic kind of naturally came up because on Friday, which was 4 days ago, Jerome Powell, the chair of the Fed Reserves, came out at their like annual meeting in Wyoming for whatever conference, I don't know the name, but he kind of indicated that, you know, we're ready to cut rates. He, in quote, he says the time has come for policy to adjust, which they will never come out and say that we will cut rates until they actually do.
Right.
They never do. They're always so cryptic.
They got to cover their ground. Yeah. Which, I mean, I get, but yeah.
Yeah, but it's crazy because the market expectations for the rates, you know, upcoming meeting and so on, it's 100% that they're going to cut rates, which you don't see very often.
We know. Yeah. To have that clarity.
And just like we talked about in the beginning, I think the market expectation is 0.25% of the Fed funds rates right now.
Okay.
Which it's not going to be that much, but like you said, it starts a cycle of the downturn, right? Of cutting it. And what the Fed kind of talked about is their like long-term outlook on where the rates will be within 2024, 2025, and 2026. And again, the Fed's always going to be cryptic, right? They never say anything, and that's for a good reason, because they could say one thing and COVID 2024 happens, right?
Yep.
And
they gotta cover their sales. Right.
But from market expectations for 2024, as we record this at end of August, the general consensus with smart money is that they will cut 0.25 in September. And for the remainder of the year, they're expected to cut 0.75 total, which no one know. I mean, if that's the case, we don't know if they're going to cut 0.25 tomorrow or in September and 0.25 for the last two meetings in November and December
Yeah.
for 0.75, or they cut 0.5 here, they don't cut the next one, and they cut 0.25 in December.
Right.
I don't know the combination, but that's what they expect for 2024. And going into 2025 and 2026, I don't think it's going to be, they're not, as long as like crazy stuff doesn't happen,
Yeah.
they should be cutting it periodically. And ultimately, what they said is 2026, they want to bring it down to 3%, right?
Hey.
So from there, we don't really, they didn't really say anything. But with them bringing it down to 3%, it actually might be a good place to be, just because
Mm-hmm.
at you're cutting rates. It's one of the tools in their toolbox. It's a very big tool, and as they come down, or as they bring their Fed funds rates down, like I say, it stimulates the economy. But the more they lower, the more they don't have, or they don't have a big of a weapon if some kind
If
of
something happens.
recession or depression or some kind of global pandemic happens. They don't have that gunpowder to stimulate the economy again.
Yeah.
But then with 3%, if they have something, they could always bring it down more and still, they still have a lot of leg room. Or it wouldn't be as crazy of an idea to bring it back up if the times
Let
calls
it go.
for it.
Yeah. Right.
So I don't know. I think the general narrative around the Federal Reserve is pretty negative. It seems like that's what I hear online, and that's what I hear from the people. But I don't know. It seems like
elaborate on that. Like around the Federal Reserve,
like they say that they navigated COVID very poorly because they cut they cut to 0% right away, and they injected trillions and trillions of dollars into the economy.
Okay.
And this is a first time that happened in their lifetime, right?
Yeah. So it's kind of hard to judge, but
just looking back, it's not all great. America is not all great right now because the rent prices, and it's just hard. It's harder and harder for everyday Americans to,
for sure,
not just survive, but for them to thrive.
Right.
But with that being said, I think it could have been much worse. And my personal opinion, I think the Fed did an okay job during COVID, and I think they're making the right decisions now. And the part that I just want to argue is for not against the Fed, but for the people that think that just bringing these rates down is going to be just all roses and flowers and just all good times ahead, which I definitely 100% agree with. But with the Fed team, I think they did an okay job navigating everything, to be honest. Only time will tell. We'll look back in 5 years, like, maybe they're the A-star legendary goats, or, it was one of those things that, like, that was probably the worst decisions that was ever made for the U.S. economy. So
I was going to say, I don't know that I'm the most qualified person to be like, oh, yeah, they navigated the COVID poorly or not, or what economic policy they leveraged to get us through. All I know is it seems like we got through without a major crash. I also think they at least navigated it to a decent degree. And then now they're taking moves now to like lower the interest rates to maneuver to navigate the economy as as needed. I don't see any like gross missteps, but I'm not the the best person to ask. But yeah, we can take some like basic policies and kind of look at them. So I don't know that I would love to hear from someone that did say like, oh, they could have did that way better. Like I would love to hear them like dissect that for sure, just to see kind of like where they're getting at with that. Yeah.
And so obviously the Fed has a dual mandate of keeping prices stable, so controlling inflation. Doesn't let it get wild, and they also want to keep unemployment to a reasonable degree.
Right.
With that being said, and looking at how you feel about the current economy, do you think it's the right time to start cutting rates, Or do you think we should have cut much earlier? Or you think that they should be holding on a little bit longer? What do you think?
Well, I'm trying to think what is the employment rate right now?
It's at like
Or what
4.3 or something.
4.3, which, and I'm trying to think what is it like at, like, what's the average unemployment rate? Is it like three?
What the Fed said that they were expecting. This is not a quote. This is, if I
Yeah.
remember correctly, type of thing. They wanted employment levels to be, or unemployment levels to be, like 4.1 by the end of 2026 or something like that.
Okay, I thought it was even lower than
But
that. Okay.
the discussion came up very quickly for these rates to be cut because we already hit 4.3 and we're at the end. We're not even into 2025,
Right.
let alone.
And that's why I was kind of
So
asking. Yeah.
they hit, so they hit their target, which is not a good target, too early.
No. So, which is the reason I was asking that question. Like, where is it and where do they want it? Because it seems like they have, there's tripwires in place to trigger the cut of these rates, right? So for those reasons, I feel like whether they would have cut it before or cut it now is good. But I think waiting is not the right answer. I think at the latest, this was a decent. I can see the logic behind why the Fed did what they did, if that makes sense. Yeah.
No, it makes sense. And
Because I think they had like strategic tripwires that they were assessing that triggered the cut of the rates. And these, if I'm not mistaken, were kind of like being talked about, like if rates were going to get cut. We didn't know when per se, but it was kind of already in the conversation. So
2024 was a interesting year,
yeah,
because
it was a major surprise.
We started off, like still high inflation, and then somewhere along the way they were like, hey, we're gonna cut 3 times this year.
Yeah.
And then a couple months later they're like, all right, we're not cutting anything at all.
And then
I remember that because people were like, oh, I told you, like, they're not gonna cut, blah blah blah, because I'm in the camp of whatever they say, that's like my best guess.
Yeah, but
right? Like, who am I don't know.
Yeah, that's what I'm saying. Yeah.
So if they said they're cutting 3 times this year, then that's what I'm gonna say. Yeah, like the Fed said they're gonna cut 3 times this year.
Mm-hmm.
And they said, oh, we're not going to cut this year. Oh, I told you so. I mean, sure, I agree with you. They said they're not going to cut, so they're not going to cut. And now it's like back to, okay, we're going to cut. And then secretly, market thinks that they're going to cut 3 times this year, right? 0.25, 0.25, 0.25. It's funny. It's funny. And I'm sure the people that are like, oh, I told you so, they're not going to cut. I mean, they're staying quiet right now, but I don't know. Maybe they could be right. They could be right. Something between now, end of August, to middle of September, something could happen. And
of course, something will always happen.
Yeah.
Okay. Well, just to ask you a question, what do you think could be the biggest downturn? Or because we view this as a general positive, which again I agree, but just for the sake of exploring the counter, what do you think could be the biggest negative of this interest rate cut, or just cuts in general?
Yeah, I think how I kind of covered it earlier too, but as the rates come down, naturally, with everything else being equal, inflation is going to uptick. And as inflation goes up, asset prices are going to go up, which sounds good.
Could be good.
But who has all of these assets? The wealthy people, and some in the middle class, and not so much in the poor,
lower class.
And these asset prices increases, like, they're going to benefit the most. And if you don't have these assets, the wealth gap is going to just get bigger and bigger and bigger. And regardless of how great America is, as that increases, I don't think it's going to, as wealth gap increases, I don't think the country is going to head towards a better place, head towards in a better direction. So that's my only concern, is people that just somehow didn't get their break, just somehow wasn't lucky enough to invest at an earlier point. It's going to be tougher and tougher for them. And as everyday Americans, like, as people get left behind, it's not going to be good for the average Joe working their job.
Well said. Yeah,
that's going to be the sad thing for me. Hopefully it doesn't get to that.
Yeah,
which is
definitely not.
which is so tough, right? Like because as people that own real estate or stocks, like you want all those to go up,
Of course, yeah, selfishly, yeah.
and then I mean you look at the bigger picture. As long as I mean, if it doesn't go up too rapidly, then kind of the happy place for both parties.
Mm-hmm.
That they can still get in, they're not too late, and
Yeah.
But then if it goes up really, really, really quick, like COVID, combined with a global pandemic where people needed money more than ever,
Right.
so maybe like they were selling their stock while the stock was
Ooh.
going up, so they got a
Yeah.
triple or double whammied.
Yeah.
Yeah,
Okay, no, that's a good answer.
Hopefully it doesn't get to that extreme level. So hopefully it just goes up slowly and steadily.
Sweet. All right, so we kind of talked through what the Fed's recent actions or what they're going to do coming up in September, navigating these rate cuts a little bit. So, like we said, we do think that it's a positive action. However, I'll say at least personally, with everything, navigate with caution. It's not always good as it may seem. I think. I don't know. B, you have anything to add?
It's gonna naturally, like I said, it's gonna benefit a lot of people, but I would say don't over leverage because you're gonna see all
Yeah.
these people on social media making so much money, and it's always a survivorship bias, right? The people that's making money is gonna be encouraged to post about it online.
Those are the only ones you see. Yeah.
So that's what you see, thinking that that's like the majority or the average, where you're like, oh, like
It's
I'm
not.
nowhere near that level. But in reality, the people that represents the median or the average or the everyday
Mhm.
people, they're not posting and bragging about their stuff online. So as times come to a good times because the rates are low, like regardless of the rates low or not, it's you got to kind of do you and look
Yeah,
at your own situation and move forward from there, not taking advice from strangers online.
for sure. Proceed with caution. Yeah. Awesome. I got nothing to add. Thank you for joining us as always. It's always a good conversation. It's always fun. And like I said, I like to mix it up with some real time topics sometimes. So we'll catch you guys next week. Thanks again.